ever wondered why some traders succeed while others fail in the financial markets? It's not just about luck or strategy, but also about effective money management. This is the art and science of managing your capital, controlling risk, and optimizing returns in the exciting yet unpredictable world of trading. Money management is like the steering wheel of a car, guiding your trading journey towards its destination, success. It's about making sure you're not putting all your eggs in one basket, about knowing when to hold them and when to fold them. It's about understanding the risk-reward ratio, the significance of position sizing, the power of diversification, the importance of stop-loss orders, and much more. Money management in trading is an umbrella term encompassing several key principles, each of which plays a vital role in determining your trading success. Stay tuned as we unravel the key principles of money management in trading. First off, understanding the risk-reward ratio is fundamental to money management in trading. It's a simple but powerful concept. Essentially, it's the potential reward you stand to gain from a trade compared to the potential risk you take on. Picture it as balancing scales. On one side, you have the risk, the amount you could lose if the market doesn't swing your way. On the other side, the reward, the profit you could make if things go as planned. Ideally, you want the scale to tip more towards reward than risk. The general rule of thumb is to aim for a risk-reward ratio of at least 1 to 2. That means for every unit of risk you take, you're aiming for at least double that in potential reward. Remember, a good risk-reward ratio can be the difference between a profitable trade and a losing one. Now, let's dive into the second principle, position sizing. Position sizing can be described as the process of deciding how much of your trading capital you're going to put into a single trade. It's like deciding how many eggs you want to put in one basket. It's a crucial aspect of risk management, serving as a protective shield against potential losses. How do you determine the right position size? It's not a random decision. It involves careful calculation based on the risk you're willing to take, the size of your trading account, and the price volatility of the asset you're trading. This way, you ensure you're not overexposing yourself to risk, while also having the potential for decent returns. Position sizing is not a one-size-fits-all concept. It varies from trader to trader based on individual risk tolerance and trading strategy. Remember, position sizing is key to managing your trading risk effectively. Moving on to the third principle, diversification. Picture this. You're at a buffet, and instead of loading your plate with just one dish, you select a variety of items. That's diversification in a nutshell. It's the art of spreading your investments across different assets or asset classes to reduce risk. Let's delve a bit deeper. In the world of trading, no single asset or investment is a sure bet. Even the most promising stocks can plummet, and the most stable bonds can falter. By diversifying your portfolio, you're essentially not putting all your eggs in one basket. Imagine if you had invested all your money in one stock and that stock tanks. It's a disaster, right? But if you've spread your investments across different stocks or even different markets, a failure in one area might be offset by success in others. Diversification, in essence, is a risk management strategy that combines a wide variety of investments within a portfolio. The rationale being that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Diversification could be your safety net in the volatile world of trading. Next up, we have stop-loss orders. These are like your own personal financial bodyguard, stepping in to protect your investments when things get a little too risky. So, what exactly are they? Simply put, a stop-loss order is a predetermined order to sell an asset when it reaches a certain price. It's like setting a limit on how much you're willing to lose before you say, enough is enough. This strategy is a vital safety net in the world of trading. It ensures that you don't lose more than you can afford to. Because, let's face it, no one likes losing money, especially not when it could have been prevented. By setting a stop-loss order, you're giving yourself a safety buffer against market volatility. The beauty of stop-loss orders is that they take emotion out of the equation. They allow you to make strategic decisions ahead of time, so you're not caught off guard when the market takes an unexpected turn. A well-placed stop-loss order can help keep your losses in check. Let's now explore the concept of risk percentage per trade. This principle is about setting a cap on the percentage of your trading capital that's put at risk in any single trade. Think of it as a safety net that prevents you from losing too much, too fast. It's a crucial part of preserving your trading capital and ensuring longevity in the market. Imagine your trading capital as a pie. Each trade you make is a slice of that pie. If you risk too much of your pie on a single trade and it doesn't pan out, you'll be left with a much smaller pie for future trades. Most successful traders limit the risk to about 1 to 2% of their total trading capital per trade. This way, even a series of losses won't wipe out their account. It's all about creating a balance between potential profits and potential losses. Limiting your risk per trade can help you stay in the game longer. Moving forward, let's discuss the principle of risk tolerance. Risk tolerance is a personal attribute, a measure of how much uncertainty you can handle in your financial decisions. It's like a financial stress test, quantifying the level of financial risk you are comfortable to bear. In trading, your risk tolerance can significantly shape your strategy. For instance, if you have a high risk tolerance, you might lean towards more volatile markets or aggressive trading strategies. On the contrary, if you have a low risk tolerance, you might prefer safer investments and conservative strategies. But remember, risk tolerance isn't static. It can change over time due to various factors like your financial situation, age, or life experiences. Therefore, it's vital to regularly reassess your risk tolerance to ensure it aligns with your current circumstances and future goals. So, how do you determine your risk tolerance? It's a blend of introspection, financial analysis, and sometimes consultation with a financial advisor. Knowing your risk tolerance is essential in making sound trading decisions. The seventh principle we'll cover is position monitoring. This principle is all about keeping a close watch on your trading positions. In the dynamic world of trading, market conditions can change in the blink of an eye, and these changes can have a significant impact on your trading position. This is where position monitoring comes into play. By regularly tracking your trading positions, you can stay updated with the latest market trends. Not only does this provide you with valuable insights, but it also allows you to make informed decisions. Think of it like a ship's captain constantly checking the radar. This helps the captain navigate through any potential storms and reach the destination safely. Similarly, regular position monitoring helps you steer your investments towards your financial goals. But remember, position monitoring isn't just about observing. It's about taking appropriate action based on your observations. Regular position monitoring can help you react promptly to market changes. Last but not least, let's talk about using leverage wisely in trading. Leverage is a double-edged sword. It can magnify your gains, but it can also amplify your losses. Essentially, leverage is borrowed capital that can be used to increase the potential return of an investment. However, if not utilized cautiously, it can lead to significant losses, potentially even exceeding the initial investment. It's crucial to understand that while leverage can escalate your profits, it also raises the stakes. Therefore, you should only use leverage if you're comfortable with the potential risks and have sufficient knowledge to manage those risks effectively. A smart trader knows that leverage is not a shortcut to quick riches, but a tool that needs to be handled with care. Remember, the use of high leverage combined with overconfidence is a recipe for disaster. So, always keep your ambitions in check and use leverage wisely. Leverage can be a powerful tool in trading, but only if used wisely. That wraps up our discussion on the key principles of money management in trading. We've taken a deep dive into the world of risk-reward ratios, position sizing, and the importance of diversification. We've also explored the value of stop-loss orders, how to determine risk percentage per trade, and the significance of understanding your own risk tolerance. In addition, we've delved into the crucial role of position monitoring and the wise use of leverage. Each of these elements forms an integral part of a robust money management strategy, one that can help you maximize returns while minimizing potential losses. But remember, it's not just about knowing these principles. It's about applying them consistently and with discipline. Trading can be a challenging endeavor, but with effective money management, you're already a step ahead. Remember, effective money management is the cornerstone of successful trading. Stay disciplined, stay consistent, and happy trading.